I'm Lee Landrum. I'm a partner with Comvest Credit Partners, the U.S. private credit division of Manulife Investment Management, and happy to be attending the BAI conference this year.
So, how do you think about the risk-return trade-off between sponsor and non-sponsor direct lending?
Very good question. Going to be talking about that today in one of the sessions later this morning. And I think in comparing both types of transactions, both can be very interesting for institutional investors. The primary difference in the two is the level of competition, the structure, and the pricing. With sponsored transactions, you get institutional ownership, you get financial sophistication and governance, you get an experienced owner who owns a portfolio of different businesses, and you also get one who runs a very efficient financing process for each of their portfolio companies, and that shows up in pricing and terms for the lender. In non-sponsored transactions, you have a much less efficient process, meaning it's generally more difficult to access those opportunities. But if you have the experience and the resources to be able to find them, you can typically negotiate higher yields for those transactions, lower leverage multiples, and better lender protections. But you have to have the resources to do proper diligence, to be able to originate and to be able to monitor and manage those transactions. So both have their benefits and both have their drawbacks. It really, as with everything in asset management, comes down to the individual asset selection.
When a non-sponsor credit goes into distress, how does the workout process differ from a sponsor-backed situation?
Sure. In the sponsor-backed situation, it's really driven by the sponsor's investment committee and by ultimately their goals and their exit timing and how they manage those portfolio companies. What you have to remember with a private equity group is that they own and manage a portfolio of businesses. Most private equity funds plan to own between 10 and 12 businesses in a fund. So they understandably know that while they'd like for every business to perform perfectly, generally over that many businesses in a fund, all of them will not. So they have to make capital allocation decisions. When they see a situation where an incremental equity investment or incremental time invested is going to improve the performance of the fund, they're going to invest that time. When they believe that's not going to be the case, they're going to focus on other portfolio companies. And you've seen that more recently in the news with several recent challenges in those types of transactions. In a non-sponsored situation, generally what you're finding is an owner. That can be an individual, a group of people, or a family. And the key distinction with a private equity-owned transaction is that owner generally only owns one business. That business is their complete and total focus. They tend to treat the employees like family. A lot of their personal net worth is usually tied up in that business. So while you can have a more emotional connection to the business, which can sometimes create challenges, you often have a process that's a little smoother, a little more efficient. The owner is focused on getting that singular business back on track as quickly as possible. So that process can be a little more straightforward.
We know that roughly 80% of private credit capital is focused on roughly 20% of sponsored companies. What does that mean for non-sponsor lending as an opportunity?
Makes it a very interesting opportunity as the private credit market has grown quite substantially over the last 10 years, specifically within direct lending. 80% of that global institutional capital, as you noted, targeting middle market U.S. businesses, which is the largest segment of the market, has gone to lenders that are focused either exclusively or almost exclusively on lending to those sponsor-backed businesses. But only 20% of those companies, as you mentioned, are actually owned by sponsors. So it creates a very large opportunity set for a non-sponsored lender. Why don't more people do it? Because it's hard. It's much harder to find those non-sponsored businesses. You have to attend lots of conferences, industry events, know lots of intermediaries, sector specialists, bankers, lawyers, accountants. It's a very broad, very large network, but you also have to have experience in dealing with that network and those people. You have to have the confidence of those people that you'll deliver on your commitments. And that makes it both an interesting opportunity, but also a challenging opportunity, which is why more firms don't do that.
How should an investor think about portfolio construction across sponsor and non-sponsor exposure?
Yeah, well, we're in Frankfurt today, so I like to use the automobile example. I think it's good to have a balanced portfolio with both. And as I often say to some of our clients, if you go to the BMW dealership and ask them which car you should buy, they're probably going to tell you a BMW. Go to the Mercedes dealership and ask them which car you should buy, they're probably going to tell you a Mercedes. Go to a dealership that sells both, you may get an objective opinion. I like to think of what we do, and we're not the only one, as selling both BMWs and Mercedes. There are advantages and disadvantages to both, but the key advantage to investing in both is being able to pivot and have your investment professionals spend time where the opportunity set is most attractive. In any given quarter or any given year, that might be more non-sponsored deal flow, and at other times it might be more sponsored deal flow. But if you have the capability of doing both, then you have an opportunity to direct your time and resources where it's better for your investors.
How do you view the current private credit landscape, and where are the most compelling opportunities today? What is your opinion?
Sure. It's a very interesting landscape today. Obviously, a lot of media attention. I'm sure you've covered quite a bit of it. A lot of talk about retail investors, a lot of talk about software. I think it still comes down to good fundamental credit underwriting. And I think it's the ability to move around, as I was just mentioning. Sometimes that's cash flow, sometimes that's asset-based, sometimes it's sponsored, sometimes it's non-sponsored. But I think the best chance of accessing quality opportunities is a very diversified approach to the sector. Still, quality underwriting, diligence, conservative structuring, after all, we are lenders, good credit agreements and appropriate monitoring is really what makes the difference. And above all, stay diversified. Don't get concentrated in an individual sector or type of transaction.
It's always the same.
Always.
Yeah, that's all for today. Thank you for this wonderful interview and enjoy your stay in Frankfurt.
Great. Thank you for your time. Appreciate it.